Good afternoon and happy Friday, September 22nd. Mark Milam here. Let's get right to it. Not the week we were hoping for, with all eyes on what would happen Wednesday when the Federal Reserve would get up in front of the podium and announce any changes to the Fed funds rate, followed by their policy statement. As widely predicted, the Fed did not alter the Fed funds rate. They left it static. That's what everyone thought they would do. But all eyes were on what would happen next at 2:30 p.m. Eastern Time, when the Fed would give their policy statement followed by their dot plot projections. We're going to get to dot plots in a minute. Let me flip the screen around here and show you how the week is finishing out a little worse than it started. So these are mortgage-backed securities. As the value of these goes down, the associated interest rate goes up. Here's September the 20th, the day of the Fed meeting. You can see we sold off there. Interest rates got worse across the board. We've rebounded a little bit here on Friday, but damage done. We're going to close out the week on September 22nd worse than we started it on September the 18th, and that is in large part due to what happened with our Federal Reserve on September the 20th. So what was it about the Federal Reserve that was so bad after all? I mean, they left the Fed funds rate alone, right? Can't be that big of a deal. Well, every 3 months, our central bankers get together and they do what they call a dot plot. They plot dots on a chart for where they think the Fed funds rate should be at the end of this year, at the end of next year, at the end of the following year, and at the end of the following year. In other words, they're projecting out years into the future on where the Fed funds rate will be, and they make these dot plots very public, and the market gets to absorb them. And if it shatters any sort of perception or idea of what the market has in mind, we see stocks sell off, we see bonds worsen. That's exactly what happened in the stock market. That's exactly what happened in the bond market, thanks to changes in the Fed's dot plot projections. Picture's going to be worth 1,000 words. Let me show it to you. So the blue dots here are what the Fed was predicting for the Fed funds rate in June of 2023. The purple dots are September of 2023, this week, September the 20th. And really all eyes are on 2024. Everybody knows 2023 is almost done. We kind of figure we're going to be in this range. 2024, 3 months ago, most of the central bankers thought the Fed funds rate would end 2024 in the 4, somewhere between 4.25% to 4.75%. That seemed to be what the majority thought. That majority has shifted now and pushed these dots further up the scale into the low 5s, potentially up into the mid 5s. So suddenly the market, 3 months down the line, is getting indications from our Federal Reserve that we're going to have to do what? Cue up Jerome Powell's favorite song, Higher for Longer, right out of the hawkish hymnal. Higher for longer is what our Federal Reserve told us on September the 20th, and that's why your stock portfolio sold off, and if you hold any bonds, that's why your bonds worsened as well. Let's dive into these dot plots, because I think the dot plots are pretty fascinating. In my opinion, these dot plots are a little bit like Karnak the Magnificent, who's holding the envelope up to his head, trying to predict the future, and I kind of feel like our central bankers are about as good at that as they are anything else. If you come down here and look at the June 2022 dot plot, this is summer of last year, what did the Fed think the Fed funds rate would be in 2023 as we close out 2023? And here's what the majority of them thought. They thought the Fed funds rate would be at 3.75%. Where's the Fed funds rate today? Well, it's certainly not 3.75%. It's at 5.5% with a high probability in November of going to 5.75. That would be a 2-point miss. We're already at a 1.75 point miss. That would be a 2-point miss on a 15-month projection for the very rate that these same people are in charge of setting. That's not too terribly good of a forecast. But if you think that's bad, take a look at this. If we continue to scroll down and we look at the evolution of the 2024 dots, right? This is what at every dot plot meeting, what our central bankers think the Fed funds rate will be at the conclusion of 2024. There's September of 2021, they're predicting it. There's December of 2021, there's March of 2022, June, September, December, moving all the way through. So essentially what we've got here is a collection of forecasts from the same entity that are predicting the same thing, the Fed funds rate in 2024. We've got 9 different forecasts of the exact same thing from the exact same entity. That same entity is in charge of setting that thing that they're forecasting, and not one forecast matches another one. So listen, if you were in charge of picking the outcome of something, and you had to give 9 different forecasts of the outcome of the exact same thing, and not one of your forecasts matched another forecast, could anyone really have any faith or trust or any confidence in what you're telling them? And the flat answer to that is absolutely not. They couldn't. If none of your forecasts match, you're probably not very good at forecasting. That's a bit of a problem. And that's one of the reasons why we're seeing our markets respond with an absence of confidence around our Federal Reserve. Let's talk about one other thing. This quote from Bullard, Fed Chief Bullard, who says that he sees another rate hike out in the future, and says he sees a very good chance of a soft landing. So this is our Federal Reserve saying they're going to continue to hike rates even though the Fed funds rate is much higher than the rate of inflation, and that they think that there's a very good chance for a soft landing. They're kind of ignoring delinquency rate on credit card loans. They're ignoring delinquency rates on auto financing, as we've seen those continue to rise, and pressing forward with their higher for longer strategy and future rate hikes on the horizon. I think the very soft landing is a very optimistic approach. We'll have to wait and see. In the meantime, if I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com.